No, the economy is weakening rather rapidly. If you look at all of what's going on, it's getting weaker, weaker, weaker. We're going to go into a recession. And why do I know that?
You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Well, he did. She handed him a softball question. The New York Times reporter echoes the Fed line. She's a mouthpiece of the Fed. So she knew what the answer was going to be before she asked the question, and why she asked it is, I don't know because I haven't talked to her, but I read her. She's reporting heavily on the Fed almost every day in the New York Times, and many people, and there is a model that's been done actually by a former Fed researcher. And the model says if you get a big change, a half a percent, a 50 basis point increase in the unemployment rate, you're in a recession. And we've had that. So that is basically telling us that we're already in a recession. If that's the metric that you're using and the model that you're using, and the New York Times reporters reported on this as well as every other reporter in the world. So she wanted him basically to knock that story down.
Okay,
you follow what's going on. This is all an inside game. These reporters are almost as if they're employed by the Fed. I read them very carefully, and I know exactly where they're coming from. And to have access to the Fed, they have to repeat what the Fed tells them, and they have to spin the spin and spin the narrative that the Fed wants spun. And right now, everything is great. We're going to have a soft landing, and the Fed is brilliant, and they're doing a great job. That is what Powell wanted to say, and she allowed him to do that by knocking this question out of the park. Basically, it was a softball question, and that she said, well, if the employment rate goes up by so much, doesn't that mean we're in a weak situation? She didn't use the word recession, but she had the narrative perfectly. She understands exactly what's going on. Remember Hanke's 95% rule. 95% of what you read in the press is either wrong or irrelevant. And this is an irrelevancy.
In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50? And how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. And so we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision.
This is number one. What all these clips? You're in the spin room. This is a Fed spin room in there. So you gotta think. People have to put things in context. What is going on? The Fed is spinning the narrative, and the press is going to echo the narrative. Now, this is a perfect example of the problems you get into with data dependency. Yeah, some of the data looked good bad a few weeks ago. Then it looks better. Then it looks bad. It's all over the place. This data dependency stuff. This day-to-day data are irrelevant. They're second order conditions. So forget it. What you didn't get was a question, and you will not get one from the reporters because they don't understand it. You will not, and the Fed doesn't want to hear the question. That's the main reason. No one asked what's going on with the money supply and what has been going on with the money supply since July of 2022. If they would have asked that, he would have said it's contracting, and that usually leads to a recession, not a soft landing. And it's growing at way below the golden growth rate of 6%. It's growing at 1.26%. And that means trouble ahead. But that's not the spin. You think Powell is going to get up there and say, we've screwed everything up. We haven't been watching the money supply. We let it contract. And sure enough, that always leads to recessions. He did say one thing, by the way, on your question. You had that chart, put that Fed chart up with the money supply, that little uptick thing. No, the economy is weakening rather rapidly. If you look at all of what's going on, it's getting weaker. We're going to go into a recession. And why do I know that? I know that because of what started to happen in 2022. And what started to happen? The money supply started contracting. It started shrinking, actually. Well, he's so far behind the curve, it's unbelievable. I mean, this data dependency thing, by the way, if you're looking at day-to-day data, he's looking in the rearview mirror. He's not even looking forward. To look forward, you would have to look at what the changes were in the money supply and predict what impact with a lag those would have on economic activity and inflation. That's what's called monetarism, by the way. Wouldn't I remember, let me remind you, who forecasted that inflation would peak out at 9% using the quantity theory of money? John Greenwood and I did. We said it was going to peak out at 9%. It went at 9.1. We hit the bullseye. Who said then that it was going to start coming down and it would end this year at between 2.5% and 3%? Well, John Greenwood and I did, using the same monetarist model, the quantity theory of money, the equation of exchange, MV equals PY. The dot plot thing is a lot of BS because number one, it's only about interest rates. It's not about the money supply and what's happening to the balance sheet of the central bank or what's happening to the commercial bank credit. But this is all this dot plot thing. They're trying to manage expectations. That's what they call it. They're trying to manage your expectations. However, we did say inflation would end the year at 2.5. The CPI in the United States would end at 2.5 to 3%. It might even come in a little lower than our forecast, but we did at one point in that same model, which we haven't updated, we did say that probably it would go below 2% early in 2025. Well, first of all, a letter is kind of aggressively interfering with what's going on with the Fed, but forget that. It shows you that the staff who wrote the letter doesn't really understand what's going on because they're just focusing on the interest rate. They never talked about the Fed's balance sheet. They never talked about quantitative tightening. They never talked about the fact that the money supply is contracting in the United States and growing at a very slow rate. That is why the Fed's behind the curve. So they got the whole reasoning and logic wrong because the staff who wrote the letter, believe me, the senators had no clue of what was going on. Some staff person on Capitol Hill wrote it, and so the staff person didn't understand anything. I think it was written in the first place because they think that we're probably slowing down and maybe going into recession, and at least one of the signatories on that is running for re-election, and that's the last thing you want to do is be running in an election when your party is the one that caused the recession, or that's viewed. The Democrats are in power. So if you're a Democrat, you sure don't want a recession if you're running, because if you want to do anything you possibly can to put a fire hose on the fire and put it out before it gets there. They're trying to put the blame on the Fed, which everybody should put the blame on the Fed. By the way, that part's fine, but they're openly saying you're behind the curve. You're going to cause the economy to crash. We Democratic senators had nothing to do with it. It's you. They're basically taking the halo off of Chairman Powell's head. That's what this letter is. Well, yes, but you have to go way back to when the pandemic hit and everybody goosed the economy, spending money like mad, monetizing the debt and everything else. So of course they had a hand in it. Who produced the deficit? The senators were involved in producing the deficit. Then who stupidly monetized most of it? The Fed. So they're both guilty. Monetary policy is often tangled up with fiscal policy. In this case, it was because the Congress served up the plate with the deficit on it. And who ate the deficit? 90% of it monetized it and bought the bonds that were being sold by the Treasury. The Fed did. And that's why the money supply peaked at an all-time record 27% year over year in February of 2021.
Okay.
And then we had inflation following all of that. Since the Fed doesn't know what they're doing and paying attention to the money supply, it's your guess as well as mine. The money supply goes up and down, up and down. The last time it was pretty calm and stable was when Greenspan was the chairman of the Fed in the 1990s, and the money supply was growing at pretty close to Hanke's golden growth rate.
So this is a question, you mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So there was people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. We only know it by its works.
One more.
Changes in the money supply cause changes in inflation, and bond yields follow changes in inflation. End of story.
Okay. All right.
So it depends on what they do with the money supply, and that will determine what happens to inflation, and that will determine yields in the bond market. Why has the 10-year bond been such a great long trade ever since I recommended trading it when it was yielding 4.8%? Now it's down about 3.7, a little under 3.7. So that's been a huge capital gain, because as inflation came down, the yield on the 10-year came down, David. And when the yield on the 10-year comes down, of course, the price of the 10-year goes up. So whoever followed my advice made a lot of money.